All righty, welcome everyone to the Hurley Investments Financial Service Commentary for November the 27th of 2018. Plain and simple, we have had a rough couple of weeks. I'm going to just go ahead. I'm going to bring up a bit of a chart here. But the short answer is the markets have been difficult. That is not an excuse to stop trying or to give up. It just isn't. It's an opportunity for part of what you do, depending on what type of trading you do. It's an opportunity to, I don't want to say get better because that's not, you've got to find a way to make the bad times better. There's my short answer. I'm going to start with our markets and just bring up a couple of charts that are going to give you an idea of what I talk about and what I'm going to go over today. If you take a peek, we were up at 27,000 here beginning of October, and obviously we hit the skids. We're down to 24,748. That is obviously a dramatic drop in our markets. Is it catastrophic? What do you think? Is this a catastrophic drop in our markets? Of course not. There you go. Got a couple of you type something in. Of course it's not catastrophic. It doesn't mean it feels good. And it's difficult when you see a jagged drop like this. But plain and simple, if you were to just use trend lines, which are not the best right there, there's plenty of drop to the downside. We're approaching an upside trend line up here. And we're in no man's land today. Obviously, if you were to ask me, I would say, hey, we're bearish. We're bearish on our Dow. If we bring it to the S&P, what do you think? 29.40, the end of September, 26.82. Definitely bearish, somewhat no man's land today. And if you go to the NASDAQ, it's going to tell you the same story. 8107 down to 7082 today. So here's the question. Here's what I'm going to suggest. When you are in the process of weathering a financial markets storm, what do you do? And I'm going to leave that open to anyone to answer. And you can answer it in a bunch of different ways. There is no right answer, but there are a couple different comments that came in that I think are going to be helpful for people. You can buy an umbrella. Which, in my opinion, would mean some long puts. Make sure you have some protection. You can collar trade. Now, before I go to that, does everyone collar trade? What's the typical financial market advice? In fact, I'm going to show it to you without asking you. I'm going to show it to you. As I find it. Should you really do nothing amid market volatility? It depends on whether you're 27 or 64. So obviously, if you're 27, what should you do about market volatility? By a quote unquote professional's advice. You weather it, you put more money in, there you go. You do nothing. You dollar cost average. And think about it. If you're dollar cost averaging, you're in your 20 or 30s, you might have already had 10 years. It's not like you're going to dollar cost average to a level that is truly helpful. If you've got 20,000 in, you're going to put another 1,000 in. You're pretty much toast, right? So what options do you have? Well, for the most part, what you do have is an opportunity to, oh, I don't know how I'd say it. You have an opportunity to put some money into hope, which is never a good idea, right? To hope to lower some positions down the road, or to hope to lower a few positions. You can go to cash. You can move more money into bonds. You can go to a money market. There are some things you most likely are allowed to do in a 401k, simple 401k, a solo 401k, a Roth, an IRA. There are some ways that you have the ability to quote unquote shelter some money. But for the most part, you're told not to do anything. You keep putting money to bed is what it comes down to. 40 or 50. You're told go to cash. Go to cash. Go raise some money, go to cash. Going to cash is preserving wealth. I understand that. But it's not growing a retirement portfolio. And sometimes you may go through a 12 and a half year period where the S&P doesn't grow, where you're paying fees, where your money manager, for all intents and purposes, is technically doing nothing for you. Never a good thing. And obviously in the 60s or 70s, I actually like what he says here. You should be in cash at least a couple years. And where does he say it? Save more, reduce risk, build up cash reserves. I can't find what I was looking for. But this is what you're told to do by most financial planners. The storms you weather depend on your age. Doesn't depend on what they do. It's not their responsibility to protect your money. It depends on your age. I'm more of a fan of the umbrella. Buy long puts. Do something to make up the downward movement other than traditional dollar cost averaging. Now, I do not think something is not going to cash. Why would it not be going to cash? Why would it not be going to cash? Correct. I like it. Good answer, Lance. Timing is a fool's game. Obviously, Lance, we've spoken about this. Going to cash misses some upward movements. In all honesty, when most people think of going to cash, they're already in a position where they're thinking that they're in trouble. If you're going to cash, for all intents and purposes, you've sucked up or you've dealt with most of the downward movement. Move to bonds. I'm not a fan of moving to bonds. If you're trying to get a stock market like return, you're going to end up running too much risk. If you're going to traditional bonds with high raising interest rates, the bonds you bought 3 years ago, you're getting churned out today for no return, actually a loss. And you're out of your traditional muni bond, not muni, treasury bonds. Haven't made anything. Your broker's made a lot by putting you into it. And he's now telling you, hey, go into the new ones. You're going to make 3 times as much as you made 3 years ago. Yeah, we'll sell a little bit of loss, but you're okay. Or stick with it. Stay at less than 1% where I charged you 3.5% to get into it. You can't get out of them. You're stuck in it for 10 years. Maybe longer with 30-year treasuries. Although in all honesty, most advisors are putting people only into something like a 7 to 10 year. You're usually not going to go through a 30-year treasury. Reason why? Well, it's harder to churn you out of it. It's harder for licensed people to continue to make money. Dollar cost average. And let's talk about dollar cost averaging. If you're putting 5K in a year and have been in 10 years, you can mostly only affect your portfolio 5%. 20 years, it drops down to 2.5%. 25 years, you can't even protect your portfolio for 1.75% by putting more money into it. You have very little effect on that portfolio because it's a simple dollar game. Because the money, for all intents and purposes, just isn't there. It's not enough that it's going to affect your portfolio. You can get out and go to another broker and have them do the same thing. So Kevin, why are you bringing this up? Because if you go the umbrella route, right? Boy, I'm doing such a great job of. If you go the umbrella route, you make up some downward movement. You pick up more shares for dollar cost averaging without having to add more money. But more importantly, probably one of the most important things, it is a untimable process. Can't spell that either. You can't predict how am I going to do untimable? I'm just going to put it like that. You can't predict the movements of those markets. There is no timable event on when things are going to come back. Now, I can say we've done great on Baidu, and I can add more shares. We did great on Disney earlier in the year. We can add more shares. Visa's kind of been a booger for me. But for the first time since I've been doing what I do, I'm running into a situation where I might not beat the stock market for the first time in 12 years. Well, Kevin, how's that possible? Well, long puts don't make up dollar for dollar on the way down. On the cycle, Facebook, Apple, Baidu, Ford, they're down the bottoms of their cycles. Bank of America. Under Armour's been okay. Visa, Disney's been okay, but just okay. I'm on a down part of my cycle that may cost me this year in being able to beat the stock market. The amazing thing is, with the G20 on Friday and Saturday, you might see a huge boost in our stock market, or for me, you might see a pretty big boost in Ford for me, Baidu, maybe even Apple. I could see a really big bounce that makes my whole year very quickly. But I don't know. So your umbrella doesn't have a timetable process on when the rain stops. You don't know when the storm will stop. I do remember in 2011, we had a big comeback, and I looked like a genius in February. I'm already thinking about what that would mean for this year. What that would mean, what I'm going to have to tell clients, what I'm worried about. But something that I learned over all the years is not going to cash, is not moving to bonds, it's not to dollar cost average by putting more money into it. It's not to get another broker to have them do the same thing. It's not annuities. It's finding a way to beat the market at its own game. And that does not involve outguessing the market. It'll be an interesting recap for November, as I have to tell some of my clients, hey, we might not beat the market this year. It might not come till the first quarter next year. But I believe in my process. I've seen my process work under any and all circumstances. So it's not an issue that I have that I feel I can't explain, that I can't show some benefit in the stock market and what we've made up this year. I have not been perfect. Missed out on $14 of Apple on the way down. Missed out on $18 of Baidu on the way down. Had some great periods, around $38. We made up, $36.40. But I'm not getting it right every single time. And I'm telling you that's okay. If you think you're going to be perfect in the stock market, you've got another thing coming to you. But your process has to make it worthwhile for you, no matter what age group or timetable you're in. The reason why, and I see two questions come in, so I'm going to hold off on both of those. But the reason why is because I found another pretty interesting article that if you look at, we're approaching a once in a century type event in the stock market. I'll get back to both those questions, but out of curiosity, what do you think the once in a century type event is in the stock market? What is the once in a century type of event you think they're talking about in the stock market? A complete wipeout, a bigger loss than expected. Impressive. The comment that they're talking about or worried about is the 20-year bear market that followed the Great Depression. And historically, they're looking at this, giving you both sides using Fibonacci's. But it's funny because markets are not linear. So neither should our analysis be. That is an amazing comment. And it's kind of funny because most people ask, well, what's your average return? Are you averagely beating the stock market? I don't understand why people keep asking about linear returns in the stock market. Because the stock market's not linear. But if you go through some of the Fibonacci's, and he's got the charts, the short answer is we could continue our bull run, duh, or we're looking at the possibility of a 20-year bear market. For me, that is a very scary thought. But I could totally see a 20-year bear market because that's the way that things are setting up. Not trying to scare you, but again, you don't know when the storm's going to stop. Where our markets end this week, I think you'll see people sell out as the G20 goes through. We're in no man's land, and if you use short-term trend lines will push you lower because we're reaching the top of a trend. Comment was made, you might not outguess, but you still need to use some rules. You cannot be sure it'll work better or not. That you cannot be sure it'll work better or not. Well, it's funny because people say it's mistakes. And what I'm going to tell you is that when you're trading in the stock market, what you're doing is trying to make your best educated guess with the information you have in front of you. That's all trading or investing is. Making your best educated guess with the information you have in front of you. Some of the guessing involves probabilities. Some of the guessing involves earnings. Some of the guessing involves being protected when you're willing to admit that you don't have all the answers. I would say we're probably going to be bearish for this week because our short-term trend line says we're bearish. I would say we're going to test the lower end of our range because we're approaching the higher range on the S&P. I would also probably say the same thing on the NASDAQ, except for the fact that today we validated a breakout to the upside on our short-term trend line. If I was to draw my short-term trend line, we're breaking out to the upside and it was validated. So maybe we'll see a bounce on the FANG stocks, on technology. I still think we'll end November down 3%. We're earning our second week of retail. We had CRM today, Seadrill, Cracker Barrel. Tomorrow, Chico's, Dick's, Tiffany's, Guess, Anacarmi and Finch, Dollar Tree, Kirkland, GameStop, VMware, Hewlett Packard. Friday, that is not it. Friday, we have Mountain, Vail Resorts, right? Ooh, looks like I did not finish these. Kind of funny. You think I would do a pretty good job finishing it, right? This week, GDP tomorrow. Friday, we have Chicago. PMI. We also have, for all intents and purposes, but I'm going to put that as international. Friday, we have the G20 meeting. I didn't do a good job this week. Let me finish this up. Where did I put it, for crying out loud? I think what we have, might need to go back. Thursday, we have China's CFLP manufacturing PMI. And then on Sunday, we will have the Japan PMI manufacturing index, and we will also have the China PMI manufacturing index. So our We will see, obviously, our futures on Sunday will come to any good news from China. In fact, if I can go ahead and open that to the group, what do you think is going to happen with the G20? What's going to come out from Trump in China? Whole lot of nothing. If it's a whole lot of nothing, then our markets will tank something fierce. Mod, I think he's interested in seeing the markets go up. I think he is too. But I think Trump has boxed himself into a corner where the only thing he can do to make the markets go up would be to, for all intents and purposes, would be to hold off, to postpone tariffs, to say that they're talking and they'll make a decision down the road. I think China's economy would do better if they were also to start to do some negotiation, but I don't think China can negotiate much more. So I do think, I don't think anything will come of it, in which case, watch out for the following week. There's some scary things in December. December 1st, no comment on the G20 talks. No trade deal. Brexit getting voted on by England, and if they're going to follow through, the European Union, as well as bonds for the second week in December. That's December 10th through the 14th. December 17th, we will most likely have one more rate hike. We've got a rough December. I don't see a Christmas rally this year. In fact, it looks bad. It really does look bad. If you're looking at what I'm trying to do, I'm trying to make sure I've got positions to get us through December. I've got a couple interesting articles. U.S.-China trade war can go on until 220. Contempt for the market by Kramer, kind of interesting. Apple analysts are way behind the curve. I find this one interesting, as well as one that really beats up on Apple, what Apple isn't doing. Obviously, I showed you earlier, that's a long one, my little bit about sentiment speaks. Are we approaching a century type event in the market? And then I also have down here what big money thinks you should do. A little something I found rather interesting, looking at how typical people are trying to deal with these last 2 weeks. What I can tell you, I've seen people in the last 2 weeks lose 23% of their portfolio. Shocking at what people are going through. It is hurtful because they don't have to do it. And then I also can tell you I've seen some IRAs that are up 1% that look at me and tell me how they're doing so much better than I am, which I will scratch my head and I'll say, you know, right now you are, but my process will catch up to you. What questions do you guys have that I can answer for you today? That's about 37 minutes. What questions do you guys have that can answer for you? What stock has hurt you the most? Mod, I've kind of got a tie, but the one that probably hurt me the most was some leap long calls in Facebook. And then I was doing great on Apple, so it's probably Baidu. Baidu's the one that's bit me the butt the most. With that said, in some smaller portfolios, I haven't had the movement on Bank of America. And Bank of America, a couple of our earnings, they went right up and came right back down, kind of like what Visa did last time. Nothing like having your protection not be worth anything. And and then needing it back again 4 to 6 weeks later. So I've got a couple that are stinging right now. The good news is on Facebook, I'm out to 2020 June for leap long calls. I'm till January 20 on leap long calls on Bank of America and Facebook. I've done okay protecting in Apple, but I wish I'd done better, at least as of recent. I could have done better as of recent on Apple, where I let some things go, where support levels were not protection, yet I had to learn that lesson one more stupid time. So I've got some contempt in my voice because of that. How did NVIDIA treat you? Not bad. I haven't really been in NVIDIA. I got out of NVIDIA at the beginning of the year at like a 500% return. And I am looking at getting back in, but I'm not looking at getting back in yet. NVIDIA was just upgraded. I can't believe, I don't remember who it was. I believe it was Merrill Lynch who put a price target at 225. So NVIDIA has like a 55% or a 50% upside. Where do you put new money? I've got a bunch of money that's cash, and there are a bunch of positions you could put new money into. I still think Visa would be a recession-proof stock. I still think Apple is one of the best companies in the world. Definitely, you could run to NVIDIA. NVIDIA has a big opportunity to, for all intents and purposes, a huge opportunity to rebound. I think Facebook has a huge opportunity to rebound. So there are a bunch of different things you can go into, but I would tell you now's not the time. And it might not be till first quarter next year. But there are a lot of opportunities that on a historical valuation point are now cheap. If you look at big money, financials, technology, and healthcare are still big opportunities. So I don't know where I would go with any of those just yet, but yes, they are some big opportunities. Good question. Are there any other questions I can answer? Interesting question, Lance. And the short answer is yes. Kevin, are you in some of the stocks you've talked about that have hurt you this year? Yes, I'm in Apple, I'm in Baidu, I'm in Facebook, my big FANG stocks. I'm also in Bank of America, leap long calls, Visa leap long calls, Facebook was leap long calls. I do have some Under Armour in my personal portfolio. Those are shares. And I've got a ton of Ford that's just there. So the short answer is yes. A lot of what I've talked about, I am obviously also in. And because of that, I'm going to sit by and we'll see how I end up my year. Right now, I might be in my first year where I am not beating the S&P 500, which I would hope it would be a lot like 2011, where some things come roaring back for me here at the end. But obviously, I can't predict the future, and I just don't know. Any other questions I can answer for you? Way to ask a tough question of me, Lance. Ida, would you buy any of the bank financials that you don't own? Yes. I look at Warren Buffett, and Warren Buffett is heavily stacked into financials. So if you were to talk to me about financials, Visa, MasterCard, a recession-proof set of stocks that is international that can do pretty well. I would tell you Bank of America hasn't come back up. I like Zions Bank as international. Morgan Stanley is one that hasn't come up as much as it can. JP Morgan always seems to do pretty good. So as I look at a stock, JP Morgan is one that I wish would do better. I wish it's one that could really, how'd I say? That's not fair to say. JP Morgan is one that I wish I maybe could do, I could afford it more. That's what I'm trying to say. But JP Morgan has also moved. It seems to be at the top end of its valuation. So if I was looking to put more money to work, a Zions Bank would be a great regional, in my opinion. It still can go up to the 130s for its highs. I like Bank of America because it's cheap. Morgan Stanley because it's cheap and hasn't moved like Bank of America. Goldman Sachs and JP Morgan, I think, are pretty much at the top of their level where I wouldn't want to. I think they're kind of there already. I don't think there's anything more that you can bleed out of those turnips that have done better than expected already. So hopefully that answers your question for you. Am I still a believer in technology? Yes, I am. I do think technology can do better going into next year. I think it's one of the few that can outbeat the market, even though it's not doing so at this time. So yes, I'm still a fan of technology. I think technology doesn't necessarily need the higher interest rates. I think there's some companies that are primed for future growth. What do I think of Twitter? Twitter, I think, is poorly run. So I would not be investing in Twitter. If you've got your rebound this year, I would be cashing it in before it disappears. What do I think of Marvel? Interesting, because Marvel, Lance has their earnings next week. I did jump on the bandwagon that Marvel has a $25 upside to it. They had good earnings, and all I've done is gone down from 18.5 down to 16 or 15.5. So I do like Marvel. I am actively in it for some accounts. And Marvel is one that I did jump on the bandwagon on the growth that they have available. And I would think that they have some pretty good upside opportunity. So, yes, I am a Marvel fan. MRVL. What I think of Facebook. Facebook falls into that Facebook, Apple, Baidu. I think they've all been overly punished. In regards to Google and Amazon, I think they haven't been punished enough. So that really comes down to some earnings returns on there, on why I just said that. So that's my expectation or my thoughts on the FANG stocks. Any retail to do well over the season, like Costco? We have tomorrow, pretty sure it's tomorrow. We have on Thursday, personal income, personal spending. And I think the consumer is doing much better than we've given the consumer credit for. So my short answer is if you're in retail now, you might have missed some of the potential upside that has already gone through it. I think you're late to retail, but I do think the American consumer will surprise you. And you'll do better in retail than you expect. Just as a heads up, I may be doing a switch on this and meeting 3 times a week. There's an opportunity for me where I may do this meeting on Monday. I'll then do a Tuesday short little lesson and maybe a trade opportunity type of scenario. And then I'm also looking at a Thursday. What do you do at the end of the week? So I may be expanding this to 3 times a week starting next year. I'll have that figured out later on. I'll keep you posted. Guys, have a wonderful evening. Pleasure spending time with you. Pleasure always talking with you about what's going on in the market and what I see. This is also obviously a great way for clientele to know my thought process and what I'm doing with their money. Guys, have a wonderful evening. I look forward to talking to you obviously next week, and I'll see you then. Bye-bye.